Hello, Core 4 world. This is Coach Brandon, and welcome to another week of the Core 4 show and building your dream life. You know, the goal of our show every single week is to give you guys consistency, stability, understanding, a frame of reference of accountability. There's so much that goes into it. And so, unlike a lot of other things that are out there that come and go, Core 4 is here to stay. And the reason why it's here to stay is because we look for real world opportunities where you can actually use your own capital and manage your own capital as opposed to giving it away. And what do we call that? We call that self custody. That's the word of the day. And so, unfortunately, there's so many scams out there. I've been scammed. Everybody on here, our show has been scammed, all of our team leaders. But at the end of the day, we want an opportunity to live our dream life. And so we can't give up. What we have to do is educate ourselves, mind our own business, and understand where we made our mistakes before so we don't duplicate it. And unfortunately, lots of times we get caught up with, hey, this shiny new nickel seems like it's amazing. But we've developed the core 4 principles that should keep you close to the gambit of not being able to lose your money. So, what does that look like? Number one, it looks like improving your mindset, always trying to educate yourself and taking yourself to another level. Number two, like financial dreams, let's talk about it. Not working a 9 to 5, right? So a 9 to 5 is how we've been conditioned. And so there's lots of information out there. We could part like subject matter experts tough on it. But at the end of the day, we all want to get rid of our 9 to 5 and be able to live free with our family and friends and live the life that we want, that we've always dreamed of. And then number three is investments. Like you have active and you have passive investments, and nothing's wrong with either. But as I'm searching for my journey of a diversified portfolio, you should be too, because you don't want to put all of your eggs in one basket, but you want to see if you can keep as much of that self custody in your control as possible. Does that mean that you won't lose? No, it doesn't mean that at all. But what it means is that you are accountable to you for your money, your business. And there's so many opportunities out here that can give you the same excitement and the same potential that we were looking at with things like Hyperverse and Novatech and Crypto Program and all that other trash. And at the end of the day, there's nothing but, I don't know, apologies, issues, all sorts of stuff that really does not make an impact on the fact that we've lost our money. So there's lots of excuses. Oh, it's going to come back here and we can hope. And I believe that it takes, 5 months to really forget, but it takes more like a year or two to forgive. And so I haven't really forgiven myself. I don't think I ever will. But at the end of the day, I understand that I've got to move on. And moving on means that I'm preparing for my retirement, which is number 4. And so all of us have to understand that, I told my kids, I said, listen, if you get a job working $40 an hour, then how much groceries can you buy? How big of a family can you have if that's what you want? How much fun can you have? How many things can you do? What happens if there's an emergency and you need to be able to relocate or move? Can you do that in your retirement? And the answer is, for at least some of us, that's not feasible right now. But as we start to prepare for tomorrow by what we do today, lots of wonderful things can happen. So those are 4 things: mindset, 9 to 5 investments, and then finally, of course, retirement. Now, we have a creed around here that we go by, and we use that same creed, and we call it Creed 1 in basketball, but that is become a subject matter expert. Number 2, become the best version of yourself. And then finally, surround yourself with people who inspire you. And that's what I do all the time. And so I know that there are people that are trying to befriend me and all the rest of that wonderful stuff. But at the end of the day, I have to be careful, because the most valuable thing that any of us have in this world is time. And so if you waste your time, if you misuse your time, if you abuse your time, there's nothing that you can do to get it back. And so hopefully, as parents or friends to other people and stuff like that, help your family, help your friends understand the value of that time and make sure that they're striving to be around people that inspire them. Because when you're in great company, my mother said when I was in 8th grade, she was like, son, you've got to make sure that you change the type of friends that you have, because then you will start to have what they have. And that really resonated with me. And so when I looked at it as a high schooler, what my end goal was, which was to obviously play basketball for those of you that know me. But I looked around and I saw some of my best friends and where they were going. They were going to Princeton, they were going to Duke, they were going to Stanford. And so, I went to Miami, so that's the Harvard of the South for all of you that don't know. But at the end of the day, the whole idea is that if you surround yourself with people that inspire you, that are doing the things, be it becoming a subject matter expert, or maybe they already are. And then number two, obviously being the best version of themselves. And you got a real shot at making sure that your tomorrow is better than today. So, with that being said, we have a wonderful, wonderful show with two amazing buddies of mine that definitely inspire me and help me get to the next level all the time. And then we also have another good friend of mine that comes on and he provides a wonderful product. And so it's helping all of us to make some significant money. And so we want to share that with you. We want to share our journey. And so in that, we have what we call the Core Forecast. And the Core Forecast is where we have Chris Pulver, who's an amazing analyst. It's interesting because Chris is one of, I think, in my opinion, one of the top 1% traders in the world, just flat out. And so he's not wrong. And that's what you want to be around. And so when you listen to his report, the idea is that you're understanding what did he talk about historically. This how you figure this stuff out. What did he say a week ago? What did he say 2 weeks ago? What did he say a month ago? What did he say 6 months ago? Because that's going to help you to determine whether or not not even in financial advice, his journey is the type of journey that you want to be on. And then you have also James Bishop. And so he's just one of the smartest people in the room 100% of the time. And so what does that mean? Like in his free time, I don't even know what to say. Like in your free time, James, like what do you do? You just read something or, you go take a doctoral class. I mean,
What's free time? My time costs money.
there you go.
you know, my time costs money.
It's
No,
about
I do read a lot. Like right now is actually just perusing through Amazon's 10Q because they lost a bunch of money with an investment in Rivian, and I was going to talk a little bit about that later on. But yeah, I want to put. I try to spend as much time in what makes me wealthy as possible.
yeah. So, what I'm going to do is we talked about changing a little bit of the format of the show. And part of that is to bring all of us up here together and really have a dialogue, because I think one of the big feedbacks that I get is, yeah, like these guys are great individually, but what would you guys be like together? I said, we'll try it and we'll talk about it, because sometimes let's just say I'm not the smartest in the room with a lot of this stuff. As you guys are talking, I can help put things together for some of the people that really don't kind of get where we're going. So I just wanted to bring you guys on. Chris, how you doing?
I'm doing great. Happy Sunday. It's
Happy Sunday.
gonna be a busy week.
Yeah, so let's talk a little bit about what we have, that's in the Core 4 journey. And, I want to talk a little bit about, eventually we'll start showing pictures and stuff like that, because you guys have your own stuff to share on the screen. But one of the things is that we have the Core Forex bot. And Chris, you've seen that Forex bot and you love it, right? And so the deal is that, as a analyst of Forex, like, tell us a little bit about your experience in terms of how it makes money.
Well, that particular robot is designed to just trade very specifically on a handful of currency pairs. So it knows the behaviors. It knows that these are very efficient. And look, most traders find these currency pairs boring, but a robot like the Forex bot is not boring at all, because when it actually is making pips and making profits pretty much every single week, that's pretty exciting just to watch a passive robot make you income. So that's a lot different than seeing a robot that is. And look, anytime I talk about automation, a trader needs to understand what the logic is. I mean, Brandon, you and I have gone back and forth on a lot of things with robots, and I think it's important that if you understand what a robot is trying to accomplish, you can get behind it, you can trust it, you can trade it. But I don't think you should just go into anything blindly. So I mean, what we have here at Core 4 with what the robot can do is it's designed to trade, very efficient, very boring, very low volatility currency pairs, which if anybody's familiar with how Forex works, that's not the Japanese yen. That's
Yeah.
not the pound crosses. That's not the crazy high expensive margins. That's not the crazy high breakouts and trends that we've been seeing over the last couple of weeks. The dollar, took a big move last week on Friday, especially. But the yen has been just ripping with strength the last like 3-4 weeks. And we're actually digesting a lot of things like, is this the carry trade that's unwinding? Is the yen going to continue to strengthen? Is this going to be at the detriment to the Nikkei 225 after coming back for a 34-year drawdown? It doesn't involve any of that crap because that's not what it's supposed to do. If that robot that serves a very specific purpose, or any robot for that matter that serves a purpose, if you put that robot into the right environment, it trades better than human most of the time. And if not all the time, because it's disciplined, it has rules to follow, it does what it's supposed to do, and it makes money. You take that same robot, put it in the wrong environment, your robot is terrible, and then you're wondering what the heck happened, and this robot's crap, and this is a scam. If you have no interest in learning how things work, you can't expect magical results when you're not actually learning part of the process. So I'm a big believer in, take pride and take a second just to conceptually understand what the logic is. What is this robot trying to accomplish?
Exactly.
And then it's easy to trade. I mean, in the final pieces, if you understand it, you trust it, it makes sense, then you can trade it. Then you trade it small, see proof of revenue, proof of concept, and then according to good equity management, trade it how you should. No robot should be given, I'm going to trade this robot for a month and it's either going to win or lose, and that's it. It's like, look, a robot might be, digging and somehow find itself in like the worst scenario at the worst possible time. And then for the next 9 months, it might make you a ton of money. You don't know. But it starts out with, if you're going to trade it small, let it be proof of concept, get a feel for it. And what I like is having robots that are also, low maintenance. I mean, something you could check on maybe once a week, twice a week at best. Yeah.
I want to add to what Chris is saying. So you have to understand, and I used to tell the students that I trained and worked with constantly, a robot is nothing more than a specific set of indicators, which is just a specific equation that's designed for specific market condition and specific currency pairs. If you take that robot, like you just said, and you take it where it's supposed to lurk in low volatility and throw it in high volatility, but that's not mean you get more, and you have to understand what you're doing, because otherwise you will just lose. And then you'll think, oh, I've been scammed or whatever, but nobody gets scammed. They just don't understand all the information and where things can go wrong.
You got to make adjustments. I mean, there's automated opportunities. I mean, we also and so for the Core Forex bot, it's $1,500 for that, and that's white glove service for all of those that are interested. And what's also interesting is, we have the Kong bot that we've been experimenting with, and so at Core 4, our journey is to check it out, take a look at it, and for both of you guys, it uses a martingale's type strategy, martingale's third cousin. And, martingale is kind of scary in general, but, this is interesting. So it loses to win. And if it goes in one trend, then, and the trend goes, or it's looking for one trend and it goes against that trend, then it will actually jump into the direction that it's going until it sees a pivot. Do you know much about that, Chris?
Yeah, I mean, I know a lot about it, and I think that look, with the proper trade size and deployment, I mean, it's the good thing is, so a lot of let me make one very clear point on martingale. Okay, the traditional martingale is you double the trade size every single time, and you double up and double up and double up, and based on the law of averages or based on gambler's fallacy, martingale typically ends very poorly. But this is not necessarily martingale, because what you're adding to is not necessarily adding to a drawdown. What this particular Kong robot is doing is just trying to actually confirm a trend and then stop out of a crappy trend and then confirm what's right in front of it, which is a solid bull trend or solid bear trend, and then go that way with a slightly bigger trade size. So when it wins, it makes up for that previous loss, and then it can reset to the previous trade size and start trading in the direction of the trend. So on a positive note, what I like about it is it's not just, leveling in, martingaling all the way through. What you're really doing is you're trying to find the actual direction the market's trying to go. and follow along. And the targets on this Kong bot are pretty tight. I mean, you're looking at anywhere between like 10 and 50, 10 and 60 pips as far as your running profits. You're looking at roughly the same for your stop losses. But because it uses, good equity management, or should, depending on how you deploy it, I would obviously err on the side of caution and be, very conservative. But let the robot do its thing, And the nice thing is based on the instruments that it trades, the forex market is moving and shaking. We're probably going to have a lot more volatility in currencies like we've seen the last week or two, and we'll probably have a lot more currencies on big liquid pairs. I mean, the dollar alone is a price maker, right? The Japanese yen is seen as a price taker. The dollar's probably, I mean, I don't want to misquote here, but I think the dollar's probably 70 to 80% of the entire liquidity in the forex market. It's ridiculous, like how popular the dollar basket is. And so when the dollar finally started to move heavily last week, I think there's some good opportunities to see some additional follow through on the dollar pairs. And I think this, the Kong robot can do really, really well. So,
so that Kong robot, you get a discount with Core 4 being a member, but it's 12,000. It's 10,000 if you're a member of Core 4. But it's interesting because we have another opportunity, and it's like a crypto. It's called Go Baby Trade. And, James, you and I were talking about this because it was like it's amazing because it buys low and sells high, right? And you keep the asset, and it does it right out of Coinbase. So again, this whole self-custody concept, and even though we're not talking about Forex, we're talking about, crypto, you're actually sort of like an active trader, even though it's doing it on its own, because you can pick your own, tokens or coins, right? So I've been in it, and in my journey, I'm up about 5%, which is fantastic. But at the end of the day, I'm thinking to myself, how do I find pairs that are basically going up, going down, going up, going down, and maybe in like a little upward ascending channel, like the technicals and I guess the fundamentals help with that. But where would you go, James, to really find a way to pick pairs that you think, not pairs, but crypto coins that you think are going to increase in value so that this particular bot algorithm, can work its magic?
There's a myriad of places that you could go. There's scanner tools out there. There's tools that you can use. There's even built within TradingView. There's a scanner within there that you can choose the indicator settings that you want it to scan for. If it's looking to buy low and sell high, something simple as Bollinger Bands or Keltner channels can work. Linear regression can work, or something as simple as two moving averages. You use two simple moving averages or exponential moving averages. I said simple, meaning like they're simple moving averages, not moving averages. But exponential moving averages is what I would use, or volume weighted average price automated trend lines. VWAP is what it's called. And you could look at, hey, as long as it is above the, just using stock market off the top of my head, but as long as it's above the 50, above the 20, you're in more of a buying zone. And if it's below the 20, look for it to hit the 50. If it breaks the 50, look for it to hit the 200. If it breaks the 200, look for your money to be gone. No, I'm joking. But, you could use something as simple as two exponential moving averages, or VWAP, or like I said, Keltner channels, Bollinger Bands. But you have to go and educate yourself, and then you have to test it. That's one of the things I'm very big on, is like, why would anybody in this world, in a world where they have access to free demo accounts on every brokerage, you could test out something while you have something that works, test out something on a demo account and see if it proves better. That's just the smartest way to do things, to help make sure and ensure that you're like, okay, I see what it's doing. I'm understanding it. I understand how it takes trades. I understand how it goes against me. And I understand, okay, it's going to go this crypto. It's going to hold on to this coin because it got in a little too soon, or the market, drifted quickly, and now it's looking to buy itself back up. So, that's I think that tool that you're using is phenomenal for sure for those that trade in the crypto market.
Yeah, so it's and it's in Coinbase. So we look for the regulated opportunities to have self custody of funds. But one of the things that you said, which was interesting, and that is, you were joking, but you lose all your money. But the deal is that you still have an asset, right? And so that asset, even though it's not as valuable, it will end up, hopefully, if it doesn't just tank permanently, if it ever does come back, then that asset grows in value, and then you'll eventually take profit. So, and that's a little different than the forex, because if you lose the trades in the forex, then it's gone, even though it's a self custody experience. So anyway, this is great. We're going to bring on Eric in just a little while, but before we do, Chris, I'm going to give you a little bit of time. I know you want to. You've got your presentation, and James and I jump off and let you do your thing, and then James come on and we'll keep rocking.
Sure. I think that this will probably be a lot of things that James would be interested in touching on as well. So if you can see my screen, um, look, though, it's no denying the last couple of weeks we've seen a pretty healthy correction. The last 2 days, really, like Thursday, Friday, we had a lot of volatility last week. Wednesday, it seemed like everything was alive and well, but it really just came back and filled some supply zones. We had a bit of a fake out through FOMC, and the market used a lot of news to make an excuse to dump the market even lower. High volatility for the last several weeks. So if I go to this chart, for example, this is the SPY in the 5 minute, but the background, the shaded red, shaded red, shaded red, that's all the week. So this was now 1, 2, 3 weeks in a row to the downside. And what we had was a nasty gap here to the downside, nasty gap here to the downside. This was a huge gap to the upside going into last week, Wednesday's FOMC, which was the end of July. And everything was, the Fed didn't cut rates, and the market didn't really take it in a bad way, because pretty much without explicitly saying we're going to cut rates in September, the market's assuming with a high probability that the Fed is going to be cutting rates in September. Well, we came into Thursday's trading with a huge reversal, and Friday was another massive gap to the downside. So we have had an incredible amount of volatility. An easy way to express that is in the VIX. Okay, so you have this huge jump. This is one of the biggest single day spikes we've seen since COVID. So this is not something to be like, it's just a little bit of a sell off. There's clearly some unrest and uncertainty in the markets right now, thinking like, is this a top? And if you read that, Berkshire Hathaway has more exposure to U.S. Treasury bills and bonds than the Fed actually owns. That Buffett has raised, gone to like almost a $300 billion cash position. Is Buffett the genius that's calling the top of the market, or is he just looking to deploy cash elsewhere for maybe things going on sale? I don't think anybody realizes that, because everything we read is fear mongering and doom and gloom. But anyway, the VIX spiked up with a big move. I've been long the VIX. I actually took profit in here in the 19s. I turned some pretty good profit on the VIX the last couple of weeks. I did miss out on this big spike we had last week on Friday. This was a single day spike, mind you. So, I was long at 1050 and this thing came up to 19. I'm pretty happy with that overall. But doesn't matter. I mean, the point is, the last probably 3-4 shows that we've done here for Core 4, I have been talking about a correction that is likely going to happen. Now, my technicals are pretty simple. This was a measured move that I was looking at for the last couple of weeks. So once we started to tip over here from middle of July, high to low, lower high to lower low, we nearly are hitting this symmetry mark. We nearly hit it on Friday. I am wondering, and I'm sure a lot of bulls out there potentially wondering, because they got beat up pretty badly on Friday. If we see a bit of a downward move this week, this past resistance offers some near-term support. We've got over 1,100 companies reporting earnings this week. If we have some lifts and we have consensus is pretty good, there may be enough in here to get this market back into this gap. I wouldn't be surprised, in fact, if after a bit of a sell-off here, we find some past resistance becoming support. In the next 1 to 2 weeks, we possibly come up here and fill this gap. But I wouldn't be surprised if we end up heading a little bit lower with some type of corrective channel. And then we're going to wait for the old classic, what's the Fed going to do? And that's going to be September. September 18th is the next Fed decision. I think that's going to make the market nervous right now, because they don't know what's going to happen over the next 30 to 45 days without the Fed actually talking, right? We're going to have more inflation data, which should be trending lower. We had employment data on Friday that was a big disappointment. We had a miss in earnings, or the average earnings rate. We had a miss in jobs. We had a negative revision, and we had a bigger uptick in unemployment rate, which triggered this thing called the SOM rule, and everyone's freaking out about it because it's always been accurate, triggering recessions. So I get it. Like, there's no shortage of bad news out there, and I understand. But I also understand that what the market tends to do is when we have these VIX extremes and we have these pretty healthy corrections. I mean, 6 to 7% in the SPY is seen as a pretty healthy correction. We have a move there of about 6.5%. I've been calling for about a 7 to 12% correction over the last couple of weeks. So, I've been calling for corrections as we were getting them going into early July. I mean, yeah, we went up and had six straight days in a row of highs, but the timing wasn't too far off. Where within a couple of weeks, we had a top, we've had a nice little correction, and the SPY's been down, the Qs have gone down. There's a big reversal of, oh my gosh, the small caps are going to be good. Small caps tanked hard last week, where we had a Thursday and Friday. This is actually Friday's candle. You can't even see it, but that was Friday. A Thursday to Friday, just abominable. That's not a word. Abomination. Well, I don't know what I'm saying. A terrible. I'll keep it like 5 cent language here. A terrible open on Friday, and the Russell came right back to where we started. So this whole idea, and I've been long on the Russell all year. I did take some profit near these highs, but I'm also longer to see if the Russell's going to play catch for the rest of the year. I don't know if it's going to. I don't know if I don't know, right? And so what I am doing, I'll just show you what my trade plan was last week. So I do have a lot of oh shit insurance trades, which are looking to pay off pretty nicely. If we keep going down, I've got insurance that pays, 40, 50, $60,000 on some of my accounts. That costs me maybe about 0.5%, 1.5% to pay me about 20 to 30% in my account. That's out there, but things would have to get really nasty for those to be big payoffs. But they're there for a reason, because I need to make sure that I'm protecting the portfolio, whatever direction the market's going to go. This is a bit of my trade management last week. I had some earnings plays. Google, I made some money on Google. I made some money on Tesla. I did take a small loss on Apple. I did actually lower my cost basis on own shares of Amazon by about $20 last week. So I own shares of Amazon now at 117. Despite the big drop, I've increased I've lowered my cost basis, and I'm still going to sit at the $200 level. We hit 201 on Amazon at these highs. So longer term, I'll sit in Amazon for a while. These are some trades here. Meta close for profit, MasterCard close for profit, Qualcomm, Tesla, Google. Took a small, actually, I took a win on Apple. It was the IWM, the Qs I took small losses on. And then NDX, I took a nice scalp on Friday. I have some repairs. Pfizer is actually looking pretty good. If I can repair it this week and get it back above $30.50, that'll be around 20 grand. FXI, I'm just looking to repair some of these China plays and lighten up some of the exposure. I own the shares at like 24. It's trading at 25 and change, but I try to get rid of it at 26.50. KWeb, same thing. I own it at like 24 and change. Try to get rid of it at 26. I'll just keep repairing those the next couple of weeks. I'm keeping cash at the ready. I'm keeping buying power. I'm trading lots of options, trading lots of futures. I'm hedging like crazy. I still think that the outlook is this. Okay. We're going into August, right? August is typically very slow. There tends to be lower volume. We have Jackson Hole near the end of the month. I wouldn't be surprised if the market faces a little bit more pain and sell off early in the week and then tries to fill the gap later this week. So my outlook is either this week or next week, we try to make some type of concerted consensus, maybe a healthy earnings week type rally. We have enough semiconductors this week to drive the market, I think, after Mag 7. And if we fill the gap, great. I still think that gets faded a little bit more. I'd say the real damage in the S&P is going to be down here. If we come all the way back down to 500, then to me, this looks like a big fat top that could be left shoulder, head to neckline, right shoulder, which is going to make us think and feel that maybe this bull market is going to resume, but that could be a top of tops where we might be in for full-on recession. We might be in for more trouble ahead with a new president, new administration, whatever happens in 2025. But that to me is where I'm way more concerned moving forward. Now, that all has to happen. That's going to be, weeks and weeks and months to materialize. But for right now, I think we're just in a bit of a channel. I think the VIX is going to settle in, maybe print into the 30s this week, but then fade. The VIX is usually a very good reversion to the mean indicator. I did take some interest in SVXY, which is a way to also kind of express that, the volatility index will not go up forever. Even during COVID, it went up to 80. I think a month later, it was back down into the teens. So it's a very quick to reverse. So if we get into like the 40s or 50s in the VIX, I'm probably going to start fading that, shorting that for a nice little hedge as well. So anyway, I was all over the place there, but long story short, positions are on, heads on a swivel. I'm going both ways, And all I'm trying to do is actively manage to make sure that any type of nastiness in the markets, we're still maintaining good watermarks, we're still maintaining profits and fighting the good fight, and also we're generating income along the way.
I love it. So, you talked about the fact that you bought insurance.
Yep.
Tell me a little bit about what that means.
Well, here's a good illustration of it. So I have a trade running on ES, which is the E-mini futures for the S&P. Right now, my trade is already paying right in here. So I did a 5,500 by 5,400, and that is a bear put spread that is worth 100 points. Okay. Now 100 points in futures is worth about $5,000. And I've got a couple contracts in that. So that all by itself could pay about $10,000 in insurance. In addition to, I have a trade out here that kind of contains it, but I also have a trade way down here that is about a $40,000 policy. And it's not really policy. I'm going to leave the policies to James. But for me, it's like, for a 10K payout with this bear put spread, if we get nasty enough and we get to this 40, 50 grand, look, my positions that I have and own, I'm going to take some losses. If I have a bullish tilt to some of my options positions, I'm going to take losses. So if I take losses, am I taking, 5, 6, 7, 10% losses? No, I'm probably taking 3, 4, 5% losses. But this is enough right here to probably generate around, maybe 10 to 15% gains for a lot of the accounts that I manage. So
Okay.
somewhere in that ballpark. So what I mean by insurance is if things get really ugly really fast, I have things that pay out like 30 to 1, 40 to 1 profits. Now, that's unusual and that's a bit of an outlier, but I'm thankful that if that's going to pay me, that is enough to make sure that my portfolio as it sits here literally a week ago, within the last week, like I think on Tuesday, Wednesday last week, I was sitting right near all-time highs in my portfolio for the year. So everyone was up and everything was good for, Tuesday to Wednesday. Thursday, I basically just washed away a little bit of the daily profit for Wednesday, and then Thursday by end of day, Friday by the end of the day, things were a little bit uglier. I was down 3% in open positions, which for me is kind of a lot for a single day move. That's a lot of volatility. But at the same time, what am I looking at? I'm looking at positions like this. I have one also on the NQ, which is the futures market for the NASDAQ, and the same type of thing. I've got an insurance position that pays me for about a 1% stake. It pays me about 20% insurance if I'm going to cash in on it. So
hold
I'll
on.
be okay. It's just a matter of, how much volatility are we going to get? How ugly, how fast does this market drop? And I'll make this reference. I mean, look, it's not COVID, okay? I get it. But what COVID did teach us, or should have taught us, is look at how much faster these market cycles can happen, right? If this market wants to dump 10, 15, 20% in the S&P because it just feels a little rattled, it can. There's nothing about this market that means it won't go down. But that being said, historically speaking, we don't really see those type of days. Okay, let me see if I've got a screenshot here, and then I know James is going to jump on. I've got some interesting data here. Let me see if I can find this. It might be in one of my ebooks that I'm putting together right now. Let me see here. Give me like 30 seconds here, Brandon.
Okay, but while you're doing that, so if it never drops to that particular level, do those contracts just expire and you just would have lost your premium?
Yes. Yeah, and we talked about this a couple weeks ago on the Core 4 show. I said if I'm hedging, if I'm truly hedging is not free. So I put on a lot of trades that are kind of like a free hedge where essentially I can get some credit for it, I can generate some income for it, but those are trades I put on probably every 1 to 3 weeks. My true hedges are more like the black swan, the oh shit hedges, where if things are really getting nasty out there, those pay 20 to 1, 30 to 1, 40 to 1, and they shouldn't actually pay me. Like probability wise, it's about a 96, 95% chance that I shouldn't make any money on that hedge. But that 5% probability for me that pays out a ton of money. So,
Yeah.
you look, if anybody watched The Big Short, what did those guys do? The whole group that was profiled in that, what did they do? They took a bet on something that should have never happened. If this market's going to dump 20 to 30% like we did in COVID for a 30-day OPEX cycle, if the market's going to do that, I better be protected because believe me, the retail traders will lose their butts if this market dumps that type of velocity in a short amount of time. Will crush leveraged accounts. Absolutely.
But this is what's great for our community to hear
Sure.
and really pay attention to is how when you're managing money,
Yep.
like you're insuring, and yeah, you pay for insurance with everything you do.
Yep.
You're paying a premium on a monthly basis for whatever it might be. So this is not abnormal. And the
Correct.
fact that you can do this and still protect your clients and help them to grow their capital even in down times is fantastic.
Sure.
Thank you for
And,
jumping in
and
there.
I just want to make it clear, like, do I think the market is doomed? Not necessarily. I think this is a bit of a stiff overreaction. Basically it's this. The market is now thinking that the Fed has made a a terrible error, and they should have cut rates earlier, and here we are, they're too late. Now the market's trying to price in a 50 basis points cut in September. Look, the reality is, if we get a better CPI print, or steady sub 3.3 CPI print, and we get, PMI maybe pops up a little bit, or, manufacturing service sectors, we have a better jobs number coming out through our July, our I guess it'd be our August jobs when we print early September. I mean, maybe it calms the storm. But right now, it's like the market has had a bit of a confidence shock when it came to Thursday, Friday's price action. That was a lot. Like I said, man, that was the biggest single day VIX move we've seen since COVID. That's not something to just be like, shrug it off. It's like, that's a little crazy. So there's clearly some heavy dumping and rotation. And like I said, the market moves and the cycles are happening a little bit faster. Just really quickly on, probabilities. Look, about 90% of the market is going to stay within about a 1 to 3% range. So up a day, down a day, anywhere between. Typically, most of the distributions are within 0 to 1% up, or 0 to 1% down. You start to get your deeper days, your 2 to 3% days. Right in here, you've got about 19 in the last 1,500 trading days. About 1% of days have been 2 to 3% to the upside or to the downside. We don't see a lot of moves outside of that. So when we get these huge gaps and huge sell-offs, 2 to 3% is a big day. But we don't really get those outliers, which you've seen. Look at this 9-10% day in the SPY once in the last 1,500 trading days. You're talking about, the last 5 or 6 years of trading once. So you're looking at the worst of the worst when it comes to these outliers. And I'm not saying that can't happen. I'm trading for that outlier because it doesn't cost a lot. For me, it's a 0.5 to 1% risk or 1% risk. I'll eat that in order to make sure that I'm protected. So however it shakes out, look, because on the upside, it's easy to make money on the upside. It's protecting and still profiting on the downside. That's really the art in trading.
This education is outstanding, and I wish I would have met you when I was 20. That would have been great, right when I was at Miami. Would have been perfect, because this is just, it's ridiculous. And I met a dude that was telling me, James, you'll like this. So there was this tutor or whatever that was working with the basketball players and stuff. And so we're riding on a train. And I thought the dude was really weird because he had like this science background in computer education and stuff. And so he's sitting there and he's like, yeah, one day the computers will be able to predict the stock market, and, robots will be around. And I just never really, I never really thought about it because I was a systems analyst major, computer engineer for my first 2 years at Miami. And, I'm in Miami, so I ended up with a marketing major at the end because I could not do basketball and everything else. But it's just so good to hear how these metrics work. So just real quick, and then Chris, I'm gonna let you go.
Sure.
But so in Thinkorswim, it's got like the expected move, right? And do you see that a majority of the time that these the next day or the next trade stays within that expected move? Is that kind of the way that you look at stuff?
Everything's based on a mechanical, standard deviation. So about 68% of the time, the market stays within a 1 standard deviation move. After that, you're into the 70s and then the 90s. It's very rare you get a 3 standard deviation move. Okay, what we have seen on some of these earning pumps, to the upside or downside, more so on the downside the last couple of weeks, you're getting those 1.5 to 2 standard deviation moves. So as expected moves go, I mean, like having a huge gap from one day to the next, if you're positioned the day before and the market gaps open 1 to 2%, you're blown out of that position that you're in if you're on the wrong side of it. So what I typically do is I don't really take any positions, through the week as far as short-term trading. But I got a good vibe for the market on Friday, for example. So here is the SPY. Let me go to the, I did the NDX trade on Friday. So on Friday, we had Thursday was an absolute reversal of Wednesday. So just put this really quickly. This was a gap up. This is Wednesday's trading day to the upside. So even during FOMC, the market was up. Thursday, we opened up, we rallied briefly, we peaked, and we absolutely destroyed the downside on Thursday. But the bears just ripped this thing lower. And then we gap from Thursday, Friday. And right here, once I let the dust settle, all I did was I put in a credit spread right there. So, I'll put this in perspective. Monday, within the expected move. Tuesday, we were down through the expected move a little bit. Wednesday actually stayed within the expected move. Thursday was through the expected move. Friday was the expected move. So 3 out of 5 days within the expected move. Okay. Most of the time, it's more like 4 out of 5, 5 out of 5. It's very rarely that you get like those one big directional days, but when they do, it's all about just maintaining trades. So, a day that's up, that's outside the expected move, everybody freaking loves those days. A day that's down outside the expected moves, that's when you see who's got positions that are protecting and who's getting creamed.
Yeah.
So I've got a chart alarm just went off. Let me check what this is. Bitcoin's causing. So I got Bitcoin, Ethereum down to some fresh lows right now. Yeah, ooh, baby.
Down 1% and screaming, to say the least.
Yep. We got some serious flow going on, man. Wow, that's crazy. So I put bear trap lows, but that was actually on this first dip. This looks a lot worse for wear, if you ask me. So Bitcoin dropping hard. Ethereum, same thing. Just, oh my gosh, dude. These are brutal. Ethereum from the recent highs, that's over 46% down. Yikes. So we got some real action. This market's going to be real exciting on Monday, and probably not in a pleasant way. I'm just going to say we're 28% down from the recent highs. So buckle up, everybody. It's going to be a friggin' crazy week.
I mean, I'd love for it to go back down to 15,000 so I can get in. That's what
I don't know if you'd get.
As a person that hopes it doesn't go to zero.
I don't know if you'll get 15,000. I think mining cost right now is like 22 or 27. I can't remember the exact number.
I could see 50. I could see 50, and then if not, we're possibly. I mean, we might revisit 30 if this thing gets really. I mean, what's been the historical pullbacks? Right, we have 70 to 80% pullbacks. Right there, if we pull back to 30 can, the big breakout, that's almost 60% lower.
Go to 22. What is that?
Go to 22. It's probably around that 70 to 80% pullback.
Yeah, that's what I thought. Generally,
that's around 70%,
very interesting. I just read a dissertation today that studied the every single major move in Bitcoin, right? Because they had a lot of them, and they do it doing a forecasted methodology that has been around forever. Okay. And every single move reverts back to the mining cost. Every move. And it's just wild. Every time it has a drastic pullback. Yeah. And it's just really, really, really odd that that's just how it works,
All right. Look, James, you're up. Eric has got to come on. We're already.
Sure. I know.
We got 18 minutes in the show. Obviously, this is the right direction where we're headed. I'm excited. Chris, I'll talk to you in a minute. Great job.
Sounds good.
All right. Perfect.
Hey, buddy. You're on.
How's it going? So a lot of stuff to I'll try to keep it shorter today, obviously because of time factors. But the first thing I want to share with everybody is this. This was announced yesterday morning at 6:09 a.m. Basically, to just give you the quick information, is basically that NVIDIA's Blackwell chips that they've been touting and being so fast and being amazing and well, they're now delayed by 3 months due to design flaws. And you have to think this is not just NVIDIA that is affected by this. One of the things that I had mentioned was Amazon. One of the big reasons that Amazon missed earnings, AWS made money. They were profitable in sales, but they didn't have as large of a beat in earnings as expected. Why? Because they were invested heavily in Rivian. And what a lot of people don't understand is that stocks don't operate in some sort of vacuum. Like the only things that affect Apple. There are two things that affect things around Apple. Companies invested in Apple, and then what you call the through trade, the carry trade or the throughput trade, which is like who makes the glass for the screens, who makes a chip, who makes a microphone, who makes the camera, who makes the chips for charging, etc. There are parts that Apple outsource, like Samsung makes parts, a glass for the Apple cameras. Not a lot of people know that. Samsung will be affected by slow iPhone sales. That's just how the world works. And if you look at their 10Q, which I just pulled up, and their 10K disclosed it as well, you can see some companies list the exact companies that they're invested in. Some companies don't. It all has to do with whether they do GAAP or non-GAAP. That's generally accepted accounting principles is what GAAP stands for. But if they do non-GAAP, they'll show something like this, right? They have treasury securities, agency securities, non-government securities. But notice here, they have corporate debt securities. $68 billion is debt for businesses that they're invested in. So they're more on like the equity side of a company. They want to own the debt, but they also have shares that they own as well that they'll go through. Now, to talk a little bit about some of the big news that happened last week, Bank of Japan on July 31st, raised rates from 0.1% to 0.25%. This is their second rate raise in forever. From literally January or October of 2010 to March of 2024, they were at 0 or below 0. So 14 straight years until they reached a flat, like a positive interest rate. That means that the government was lending money to banks and getting paid less back. Now it's at 0.25%. Yeah, my good buddies at BlackRock, they called me and said, hey, look, James, just want to let you know, Japan's a great place to invest, and we're going to invest in building and things like that, and then get into their market as well at the right times. Well, the right time was not at this high at $42,000. It's approaching that right time right now, falling 9,000 points from July 11th to August 5th. 9,000 points. And we're coming up against resistance. We'll see if this resistance holds in the Nikkei. But the other thing in getting back into the U.S. market, a couple of big announcements that I want to share with you all yesterday as well. On Saturday, Berkshire Hathaway disclosed selling 49% of its stake in Apple Q2 at $219 a share. 49% of Apple being sold by Berkshire Hathaway. Do you think some other people may sell based on what the good old Oracle of Omaha does? More than likely, yes. So you have bad news for NVIDIA, bad news for Apple. I'm just going to go out and say that we're probably going to see some downside into the market early next week, and a continuation of that. You know, I don't believe in good news, bad news. I just believe in the news, and it's all in our reaction to what gets reported, right? Look, cars, auto loans, their defaults are up 24% this year, this quarter, 24%. Increased repossessions, mortgages, first-time foreclosure notices up 37%. Job market not great. It just is what it is. I think that, and it doesn't matter. The Fed could cut tomorrow, and yeah, you'd probably get a rip up in the market a little bit because people will feel happy that the Fed cut, but it's not going to affect companies until 4 to 6 months out. Why? I think it would affect the currency before it affects the companies, because the companies, they have to, the first priority, refinance our debt to the lower interest rate. The second priority is hiring. That takes time. Engineering, that takes time. New product, that takes time. New projects, that takes time. So it takes time for these things to happen. Credit card companies, they'll raise rates quick. They won't cut your rate as fast, right? Same for, mortgages will fall in 30 days or so if they cut rates. But quite honestly, I see a small cut in September just to see what the market does. Probably another cut in December. And then after Q1 earnings of next year, I think we will see the big cut happen. I think we'll see like 0.25, and then go into a 0.5 or 0.75 cut. And then we'll probably live somewhere between 3 and 5% for the next, maybe 2.5 to 4.75% is where interest rates will live for the next 5-10 years, and that's actually an economic sweet spot. The 90s, the 70s, the 60s, the 50s, they all had these pockets of 5 to 10 years where they were between those two rates, and businesses thrived. Wall Street and Main Street boomed, but it was all predecessed by some pain. And that's what we have to go through. We have to go through the pain of printing money and the pain of quantitative tightening. Not enough gets talked about with quantitative tightening, and that is the exact opposite of what they call quantitative easing or printing money. It's removing money from the system and getting it out of the economy, and that's what we're more than likely going through, and what we're seeing now. So, do I think we'll have a recession? A small one. I think we will have a Main Street recession, but a Wall Street blip. I think there's too much good and too many opportunities internationally as we look at corporate profits internationally to help bolster the stock market. So I do think that markets will be fine. This is why you need you need both experienced market managers like myself and Chris, and ways to prevent you from having to participate in loss, and that's the biggest two things. So that's I'll wrap it up there, Brandon, and try to get us back on time a little bit.
Dude, that was great. It's incredible just to hear you guys talk. I'm not gaslighting and all the rest of that stuff. I don't even know what that means. My kids be telling me that kind of stuff. But the deal is that when we start thinking about logically what's happening in the world and we analyze, it helps us to make better long-term decisions. So fantastic. Thank you, buddy.
Absolutely.
All right. So just as we move forward with the show, I want to introduce Eric. Eric is a good friend of mine. He's a super genius. I want to give him some time to share with us. Eric, talk to us about yield farming. You got the floor, buddy.
Yeah, can I share my screen here? I just want to see if we can do that. Hang on just a second. Entire screen is probably easiest. Okay, so I went to the Bitcoin conference this weekend. Ended up winning some awards I didn't even know that were available to be won. But what I wanted to show you right here is we were just talking about in the call what the markets are doing, how they're going up and down, right? One of my favorite markets that I like to trade in is Solana. And this is a 3-month chart of Solana, right? So it's gone up and down, and just in the last few days, it's coming down like everything else, even though theoretically speaking, the currencies really shouldn't be following the stock market. If you understand conceptually what crypto is about, it should be more along the lines of a safe haven. But you got so many institutionals in here that they treat it like a stock. Anyway, what I wanted to show you here is that in the last 7 days, we've had this spiral down. Well, I wrote some software that automatically trades in some pools, and I want to show you what that looks like because you can learn something from it about the liquidity pool trading that's really, really helpful in this market, right? So we're talking about all the things that people are doing to prepare for this choppy market, and then particularly the fact that it's going down. Well, on August the 1st, I threw $1,000, or the day before August the 1st, I threw $1,000 into a pool and I run my software on it and I made 10% that day. Okay. Um, this was just testing this thing out, threw $1,000 in there. And I have my system automatically converts things into US dollar profits. It automatically converts them into US dollar denominated currencies so that we always have some money on the side to go back into the market or put in our pockets, right? So then I thought, okay, well, it's working. So I'm going to go ahead and deposit some more money into the pool, the software. And my point in showing you this is that if you look at the balance here, and this is when I put a full 15 grand in here. This was on August the 1st, right? So let's look at the chart of Solana on August the 1st. Okay, here's where I put the money in, somewhere around here. And the money's been, and the Solana's been going down, 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 down. Okay. And so is Michi, which is on the other side of this pool. It's going down, 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 down. Well, while the market's going down, 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 guess what's happening to my earnings from all the trading that's going on? I'm actually making 10% a day right now. This is the next day, August the 2nd. Now I got $1,000 in there. The next day I've got, oh, this is still the same day. Sorry about that. I stopped keeping track. Um, by the third, I've made, $2,800 off of 15,000. Now my balance in my equity is going down, right? Because these underlying assets are going down. But guess what? While these underlying assets are going down, I'm still making 10%, 15, 16% a day. And the harder they go down, the more trading is happening, and I'm still making money. And this is not a leveraged position, by the way. I can pull out at any time. So my balance is going down, but I'm still making crazy money here. So then I go over here, and this was my balance. I think earlier today was $3,500. That was on August the 4th this morning. Okay, and now my balance, that because the prices of these underlying assets are fluctuating around, I made it was up to $10,000. Okay, but we're down from $15,000. But guess what? I'm still making money. So right before we jumped on the call here, I had $4,200 in there. So in 4 days, and I didn't have 15 grand in there, and the market's zigzagging all over the place. I have made profits in US dollar denominated currencies of $4,200. Okay, 10%, 15% a day. Now, that's running my automated software on this pool. So that's not necessarily going to be your returns, but I'm showing you that because you can get something like this to occur. I'm trying to show you the illustration of the fact that even when these current underlying currencies are going down and the market is crashing, so to speak, if that's what's happening, we're still making money over here. And we're
So,
making it in US dollars. Okay. So
and
this
and
thing can
Eric,
go down. In fact, I keep some money on the side. I can plow this profit right back in when this thing hits rock bottom and then come back and make some serious money. So that's what I wanted to show you guys to give you an idea of the power that is
of our
associated with, what we're doing here.
So Eric's course is $650 with Core 4. It's 3,000 outside of Core 4. Eric, if you're making 10% a day, and this software continues to do that, you'll be able to charge whatever you want. I mean, that's just absolutely fantastic, and I'm proud of you for putting that together. And I know we've talked about it before. And one of the things that I want to point out is you can get 100% of your return just on the fees that are going back and forth. You can get 100% on your investment in a short period of time, even if the underlying assets drop down 50, 60%, it won't matter. And then when it comes back, you still have the asset of value. So that's what I love about yield farming and the way that you express it. So thank you.
All right. God bless you.
All right, you too, buddy. See you soon. Guys, look, we're running out of time, but time is the most valuable thing that we have. And so when you think about building your dream life, think about the fact that, we've just brought you three incredible individuals that are making a heck of an impact, not only in their lives, but in the lives of others. And so, the show is about our journey and not being financial advisors, but really telling you about how to get from where you are to where you want to be is something that takes intention. I'll never forget a gentleman who's like a father to me. I asked him, "Why didn't you put me in this job?" And he's like, "You don't have any initiative." And I was like 30 years old. I was all mad and angry and all the rest of this stuff. And then years later, I realized that he was right, and what could I do differently? And so what I learned is I need to become a subject matter expert. I need to become the best version of myself. And I need to surround myself with people who inspire me. That's my creed. Hopefully it will become yours. I love you whether you like it or not. Thank you for joining the Core 4 show. And we have so much more to come, so much more to share. And we're going to be building out a heck of a website so you can see how our journey can impact your life too. Thank you.